Property and Casualty Initial Insurance Licensing, Chapter 3. This is going to be Common Policy Provisions. First, we start talking about the policy structure, and an easy way to remember that is the acronym DICE or DICE. The D in DICE stands for declarations. This is the basic underwriting information. The first page of the policy is known as a deck page within the industry, and this is the who, what, when, where, and how much of the policy. So basically all the basic information. If you're going to compare policies, the best way to do that is going to be to look at the declarations page from the previous policy that they were looking at so that you can give an apple-to-apple comparison between the two policies. The I is going to be insuring agreement. This is the legal structure, and it includes the insurance company, insurer's promise to pay, who the parties are to the contract, what coverage is provided, what perils are insured on the policy, and it also includes the insurer's duty to defend the insured on liability policies. The C in DICE is going to be for conditions. These are basically the rules and procedures of how the policy works, right? So it is the duties of both the insured and the insurer. And then E, lastly, is going to be exclusions. This one can be very specifically important, especially on any open perils policies, but definitely on all policies. And it details the specific perils, persons, and property that are not going to be insured under the policy. Common definitions. The named insured. This is the person or people that have been listed on the declarations page specifically, right? Under commercial policies, there may be multiple listed, but the first named insured has all the full control of a commercial policy. So the first named insured is literally the first one on the policy. And then there are sometimes additional insureds, people that are not named on the policy, but they are covered by the policy under that first party class. The insuring agreement, and the insurance company, the insurer, in return for premiums, must be fair in their underwriting and pay for any covered losses, right? And this is something that is highly regulated by the Texas Department of Insurance and other departments of insurances. Additional and supplementary coverages are going to be provisions that provide additional coverages to the insured at no additional premium, meaning that they do not come from the limits of coverage. Some common conditions, very common in commercial policies, is going to be a deposit and premium audit. This is where basically if you've got, say, a commercial building, and what ends up happening is instead of going out and getting an appraisal on that commercial building, they're going to just get a quick estimate so that we can get things started quickly with them, get them insurance pretty close to right away, and then the insurance company has the ability to come back and audit and get the correct amount up to 3 years after the policy expires, right? So this is what we call a deposit and premium audit. The notice of claim, this is going to be a common condition where it is either written or oral from the insured, from the first party to the insurer, second party, could be the insurance company or the agent, that a claim could be coming, right? So example, hailstorm came through the other day, and you make a note to your insurance agent that, hey, I heard some pretty loud bangs on the roof, but I haven't gotten out there to take a look yet. It may be that I need to put in a claim on the roof, but I'll take a look at it and let you know. This would be considered a notice of claim. Proof of loss. This is always going to be required for any property policy to pay out any loss. It is a written sworn statement from the insured to the insurer, from the first party to the second party. And in the state of Texas, you have 91 days. This is actually unique to Texas because most states are actually 60 days. But in Texas, it's actually 91 days. Anytime that you have a disagreement on the value of property, this is called an appraisal. This requires written demand, and then each party has 20 days to select their own appraiser at their own cost. If they can't agree on a value of the property at the point where the two appraisers get involved, It can go to the next level where an umpire would be selected by both within 15 days. If they can't agree on that, then it can go to court. And in the case of appraisals, these are binding decisions if it gets to that level. Now, just in case you have a liability dispute, right, as far as the valuation of how much liability will be paid out, this is going to go through a process called arbitration, separate than the appraisal for property valuation differences. So this is typically the method of settlement for almost all casualty claims, but this is only for casualty, not for property, okay? Only for liability. A common policy provision of assignment means that the insured, the first party, may not assign the policy without written permission of the insured, the second party. So you can't sell both the motorcycle and the insurance policy that comes with it without getting approval from the insurance company. Abandonment. This means that the insured may not abandon the property to the insurer. So the first party does not have the right to abandon the property to an insurer. This typically will come up when somebody does not get a full amount of the property loss that they're looking for. They may just get a partial loss, and we'll talk about that more in a second. The other insurance clause, this is going to be when you have either more than one insurance policy on a property, which typically comes when there's split ownership. This is how the insurance company decides which insurance is going to pay what, right? So this is already preordained out there. If you look on page 45 in your book there, you're going to have three different methods. You're going to have the pro rata method. You're going to have the contribution by equal shares method, and the primary and excess, which is the most common for automobile insurance. So for the pro rata method, the first thing you got to do here, and this is where you may have to use a little bit of math, is you got to figure out exactly how much total insurance is by all the different insurance companies is on there. So you add up all the different insurance amounts, and then you figure out how much the total is. Then what you do is you take the amount that each insurance company has versus the entire total, and you divide that through to get a percentage, right? And that percentage is the pro rata percentage of the insurance that that insurance company is responsible for. Therefore, any claims that come in will be split on a equal percentage basis based on the pro rata to each insurance company. Now, in a situation where you've got contribution by equal shares, what ends up happening here is that each insurance company is going to equally split the insurance loss throughout the policy for each individual situation. So if you had, say, two companies there on equal shares, company A with 25,000, company B with 75,000 for a total of 100,000, and there was a $40,000 loss, company A and B would both be responsible for a $20,000 payout in the event of a $40,000 loss. Now, the one general tenet of all insurance is that you can't pay out more than you're insured for, right? So the insurance company will stop at where they're done there. So in an equal shares contribution by equal shares example where you have greater than the amount that could be normally split equally, say the same example there at the top of page 46, where you have company A at 25,000, company B at 75,000 for a total of 100,000, but the loss is $60,000. The normal split would be 30,000 each. However, in this case, because company A only has $25,000 of insurance on the property, they can only pay out $25,000. So in this case, company A would pay the $25,000 as the maximum that they could pay. And then company B would pick up the remaining amount, which would be $35,000. And then, of course, primary and excess is basically where the first policy is going to be considered primary. And then once that policy is exhausted, then the second policy, the excess policy, would come in and pay the additional amount. This is common for auto insurance, and we'll get into this a little bit later for personal and commercial auto. But basically, the insurance follows the car first and then the driver. So if you borrowed the car, like in the case that we see there in the middle of page 46, where John borrows Joe's car and got into an at-fault accident causing $40,000 in property damage. The policy that insured the car had a $25,000 liability for property damage, and that one's going to be primary and will defend John and pay on his behalf up to that amount. And then since the limits are not enough to settle the entire claim, then the driver, John's auto policy, will then defend John and pay $15,000 for the remaining amount of property damage as an excess policy over Joe's policy. So what ends up happening here is that it just comes in, goes with the car first, then the driver, and that's how that works. Next concept here is called subrogation. Subrogation is the insurer's legal right to seek damages from an at-fault third party after it has already reimbursed the insured, the first party, for the loss. So basically what this means is that once you've taken a check from the insurance company, you no longer have the right to sue the original cause of that accident or loss. That right now transfers over to the insurance company. Now, that doesn't mean if there was gross negligence or willful intent, things that are not covered by that check, that the insurance company did not pay you out, that you could still not go after that from the original party. But for anything that's already been paid out, you no longer have the rights for suing the original party. Cancellation versus a non-renewal. Okay, so cancellation is defined as the termination of an enforced policy by either party, both the insured or the insurer. The insured has the right to cancel the policy at any time for any reason, right? There is no insurance policy out there that the insured does not have the right to cancel it at any time for any reason. Now, it may require that you do this in writing, but that just happens to be one of the conditions of the policy, right? Rules and procedures that they must follow. The insurance company, though, must in return for any unearned premium, they have to return that on a pro rata basis unless the insurer can invoke a short rate cancellation. So what we're talking about here is basically if you paid, say, for an entire year of insurance and the insurance company has to cancel you out after 4 months, they're going to give you back 8 months of premium in that case. Right now, generally, the short rate, most companies will have this invoked in the first quarter on an annual basis, right? So if you're within the first 2 months, say on an insurance policy, and you got the annual rate discount, they're going to charge you a penalty fee over a standard pro rata called a short rate cancellation because you took advantage of the lower pricing for the annual policy, right? Now, separate than a cancellation, a non-renewal, this is going to be a determination of an insurance policy that is at its expiration date, right? So in this case, the policy is considered fully earned, and therefore there would be no refunds. Now let's go over a few test questions to see if we can kind of follow along here and get this all completed for you guys. All right, so number one, 4 policies apply to a $40,000 loss. Policy 1's limit of insurance is $10,000. Policy 2's limit is $20,000. Policy 3 limit is $30,000, and policy 4 limit is $40,000. Using the pro rata method, determine out how much policy 1 would pay for the loss. Again, what we do is we calculate the total amount of insurance, so $10,000 plus $20,000 plus $30,000 plus $40,000 comes out to $100,000. $10,000 is policy 1's limit out of the $100,000, so that's a 10% pro rata responsibility for policy 1. So therefore, 10% of a $40,000 loss would be $4,000. So the answer here is B, $4,000. Number 2, in which part of an insurance policy is the provision to pay the claim found? Is that going to be A, declarations, B, insurance agreement, C, conditions, or D, exclusions? In this case, the provision to pay a claim is one of the rules and procedures, so therefore it is a condition C. Number 3, Mike's pristine 2016 Ford Mustang was badly damaged by hail, and the insurer assessed the repair cost to be considerably less than the current value of his car. So this is a partial loss. Mike was concerned that the damage could not be repaired well enough to satisfy him, and he did not want to drive a quote-unquote less than pristine car. So he demanded that the insured total the car so that he could buy a brand new one. So what condition in the policy would address this situation? Would it be A, other insurance, B, arbitration, C, assignment, or D, abandonment? So in this case, because he's trying to abandon the car to the insurance company because he doesn't agree with the assessment of the partial loss, it is D, abandonment. Number 4, how many days after the insurer's request must the insured provide a proof of loss in the state of Texas? Is that 30 days, A, B, 60 days, C, 91 days, or D, 61 days? So in this case, it is 91 days, which is unique to Texas. The answer is C. In which part of the policy is found the insurer's promise to pay? A, declarations, B, insuring agreement, C, conditions, or D, exclusions? So this one is going to be B, the insuring agreement, right? This is where the legal terms of the policy are laid out, and the insurer's promise to pay happens to be one of those legal terms. Number 6, in most commercial policies, the premium is A, in dollars, B, fixed, C, more than personal policies, or D, estimated. In commercial policies, most of the time, you're going to have estimated premiums, right? This is just to get that whole process going a little bit quicker, and therefore, that is what we've got there. Now, number 7, when the insured and the insurer disagree on the value of a damaged insured's property, the condition to settle the disagreement is called A, arbitration, B, appraisal, C, subrogation, or D, notice of loss, right? So remember on this one, when we're talking about a property value disagreement here, this is going to be appraisal, B. When more than one policy will pay for the loss, which condition would apply? Is this A, subrogation, B, notice of loss, C, other insurance clause, or D, pro rata method? So the most correct answer here is going to be C, other insurance clause. Pro rata method D is actually a method within the other insurance clause, but it is not always the one that applies, right? So it depends on the policy, especially on an auto policy, that would not be correct. Number 9, when a policy is terminated in the middle of the term, midterm, by the insurance company, the insured gets what? Is it called A, the unearned premium, B, a short rate refund, C, notice of non-renewal, or D, the earned premium? So what you get is the amount of money that was not earned by the insurance company, so it's called the unearned premium A. Number 10, an insured's car was damaged in a fire that started when the neighbor set off the fireworks to celebrate the 4th of July. The insured's insurance company pays for the damage and then files suit against the neighbor to recover the amount that it was paid for the loss. This is an example of the application of what policy condition? A, liberalization, B, subrogation, D, C, abandonment, or D, assignment. So again, this is the third party right for the insurance company to go after the original party, called subrogation B. Okay, so that's the end of chapter 3.